Over the last few weeks, the US stock market has bounced back, seemingly shaking off the geopolitical turbulence and energy shocks spreading across the globe. Many economists look at this rally and conclude that the economy is resilient. They point to real US GDP growth, which has been hovering nicely in the 2 to 3% range, arguing that this provides a healthy cushion to weather any incoming storms. But this chart of historical economic downturns tells a different story. These markers show the official start dates of NBER-classified recessions. Notice exactly where they begin. They almost all trigger right when GDP hits that 2% threshold. This 2% mark we see today is the exact historical threshold where sudden economic contractions actually start. And right at this precarious edge, the economy absorbed a massive sudden blow. Geopolitical conflict triggered a spike in the price of oil to $95 a barrel. Look at this chart mapping 7 comparable historical oil shocks. 5 of these 7 were followed directly by official recessions. History gives us a strict timeline. The average window between the initial shock and the start of a contraction is just 4 months. This market rally is front-running a rumor of a ceasefire. Meanwhile, the 4-month countdown to a recession has already begun to tick. To see exactly how that shock cascades through the system, we have to track the money down to the US consumer. Consumer spending is the vital engine of the economy, making up 70% of total GDP. Before the conflict began, the Federal Reserve's real-time model showed a steadier baseline. The consumer contributed a solid 2% to annual real GDP growth. But look at this breakdown of GDP growth today, just 1 month into the energy shock. The contribution of consumer spending has abruptly shrunk by half, dropping from 2% down to just 1%. Higher costs at the pump and broader inflationary pressures across goods drain household budgets fast. As that consumer spending dries up, corporate profit margins get squeezed, eventually forcing businesses to initiate layoffs to protect their bottom line. When the job market was already slowing to a complete standstill, with oil at $60 a barrel, it lost its ability to absorb a shock of this size. This fragility means the economy lacks a job market buffer to withstand a sudden collapse in consumer demand. While retail investors might still be buying stocks in hopes of a swift recovery, the institutions that manage the plumbing of the global financial system are flashing warning signs. We can track this institutional fear using the Bond Market Volatility Index, commonly known as the MOVE Index. Recently, this metric has spiked violently upward. This MOVE Index chart reveals a pattern of panic seen only during severe crises: the 2008 crash, 2020 freefall, 2022 inflation surge, and today. Overlaying the Shiller PE ratio shows a strict inverse relationship. Every time bond uncertainty spikes, stock valuations inevitably plummet. The math is unforgiving. High institutional distress suppresses the premiums investors are willing to pay for equities, meaning the current stock market rally lacks a foundational floor, and a severe downward correction is approaching. When you combine a contracting economy with surging oil-driven inflation, you enter a highly specific, notoriously destructive environment known as stagflation. The standard investor reflex when facing a market crash is to sell off their equities and hoard cash to wait out the storm. In a stagflationary crisis, that defensive instinct is a trap. Because the cost of raw materials and everyday goods is accelerating, sitting in cash guarantees a rapid, silent destruction of your purchasing power. To survive a period of stagnant growth and high inflation, the strategy requires moving aggressively out of cash and taking positions in the exact physical assets causing the inflation in the first place. We have a clear historical map for this. During the brutal US stagflation crisis of the 1970s, while the broader stock market suffered, a few distinct sectors thrived. The first major winners are raw materials. Despite low economic growth in the 70s, the price of industrial metals skyrocketed. Today, we are seeing metals like aluminum stage a similar multi-decade breakout. The second core sector is energy infrastructure. In the high inflation environment spanning the 70s and 80s, the earnings for these massive physical operations didn't just hold steady, they tripled. We are witnessing that exact precedent unfold right now. After a decade of stagnant growth, the companies building and maintaining the infrastructure for raw energy extraction are already seeing their earnings accelerate higher. Instead of panic selling during this false market rally, investors must use this narrow window to reposition their portfolios into infrastructure and raw materials, transforming an unthinkable economic shock into a calculated positioning for the years ahead.